The American Congressional Exchange is a program that we have that BPC started where we bring two members together, a Republican and a Democrat from two very different parts of the country, and we have them visit each individual's districts and really get to know not only that member, but also that district.
Now, up until that trip, I did not know David Trone. And because of his willingness to make the trip, to come out, to spend that time with me, I can testify that I now have a friend and an ally on many issues of mutual concern.
Many of us share the same principles, and we bring to the table different life experiences, different political perspectives. We shouldn't find that dangerous or divisive. We should find it something to celebrate.
This is how America works, is by coming together, rolling up our sleeves, getting away from the partisanship, getting away from the rhetoric, and getting back to just delivering.
When you have a conversation with people and you laugh and you get to know them, you no longer see them in the same light, and you're much more willing to say, let's figure out how we can be friends and really find solutions. It creates a different type of dialogue and friendship that exists, and it also allows those members to see how different parts of the country are and how many similarities there are.
Good morning, and thank you for joining us on this Friday morning. It has been quite the interesting week in the financial services area. We began the week with news that the First Republic Bank had been taken over by federal regulators and most of its assets sold to JP Morgan Chase, making it the second largest bank failure in U.S. history. The same day we learned of First Republic, the FDIC proposed reforming the deposit insurance system to allow for different levels of insurance coverage across different types of accounts, with higher coverage for business payment accounts. And then on Wednesday, the Federal Reserve raised interest rates for the 10th time in just over a year. On Capitol Hill, lawmakers are taking a close look at U.S. banks, how they're run, and how they're regulated in hearings this week, with more to come both in the House and Senate. It's important to note that banks fail throughout history. We've had a number of them, but this moment feels differently. And to dive into all of this, my colleague Steve Scully is going to interview an amazing suite of speakers. So we'll start with Da Lin, an associate professor of law at the University of Richmond, where she teaches, and writes about corporate governance, securities regulation, and financial regulation. Professor Lin testified yesterday before the Senate Banking Committee, so we're especially thankful that she found time to join us today. Before coming to Richmond, Professor Lin taught as a Klemenko Fellow and lecturer of law at Harvard Law School. She received her AB and SM in Applied Mathematics from Harvard University and her JD from Harvard Law School. After graduation, she clerked for Judge R. Lanier Anderson III on the 11th Circuit Court of Appeals and practiced at King & Spalding, LLP. Following Dr. Lin, we'll hear from two former members of Congress, both experts in financial services. First, John Delaney, a BPC board member, is chairman and CEO of Forbright Bank. Delaney served 6 years in Congress from 2013 to 2019 and earned praise for his bipartisan approach to economic trade, foreign and environmental policy. In 2019, Congressman Delaney stepped down from Congress to run for the Democratic nomination for president. By the age of 40, he had founded and led two New York Stock Exchange listed companies, and at one time was the youngest ever CEO on the New York Stock Exchange. He received his undergraduate degree from Columbia University and his law degree from Georgetown Law Center. Our final guest will be Randy Hultgren, a former member from Illinois. He is currently the CEO of the Illinois Bankers Association. Congressman Hultgren, an Illinois native, served a number of years in elected office, including from 2013 to 2019, representing the 14th Congressional District of Illinois. In Congress, he served on the House Financial Services Committee. And prior to his time in Congress, he served as a member of the Illinois Senate from 2007 to 2011. In addition to his public service, He's worked in finance, banking, and law, including as senior vice president of commercial lending with Wintrust Financial. I will now turn it over to my colleague, Steve Scully, who likely needs no introduction from our audience after having spent 3 decades on TV through C-SPAN. Steve, take it away.
Hey, Michelle, thank you very much. And clearly, with 3 banks failing in just the last 2 months, we have the experts who can really give us a firsthand account of what happened, why, and what is next. We'll get to the 2 members of Congress in just a moment. But Professor Lynn, thank you for being with us one day after your testimony. And part of your message, I had a chance to watch your opening statement and the Q&A before Senate banking, was really looking at management, or maybe better yet, mismanagement when it comes to banks. Your message is what?
My message is that right now we need to strengthen our enforcement authorities against senior bank leadership who have engaged in mismanagement. Right now, this authority is rarely used against senior bankers, the CEOs, the chief financial officers, the chief risk officers, and the board of directors. Bankers have been prohibited from the industry, but the overwhelming majority of those bankers are rank and file employees. And this disparity is troubling. A big part of the problem is the requirements for prohibiting bankers from the industry that require a finding of dishonesty or willful, that is knowing, intentional disregard for safety and soundness. And as I mentioned in my testimony, failed management is seldom provable as a deliberate act. It's seldom a demonstrably deliberate act. In large and mid-sized banks with their diffuse decision-making processes, top executives create the structures, the systems, the protocols, and the cultures that incentivize wrongdoing, but they rarely actively participate and know about the operational details of a bank. So they end up shielded from prohibitions and other forms of sanction. And second, this is getting into the weeds of the statute a bit, but the statute focuses on who knew and participates in discrete wrongful activities. But in reality, as I just mentioned, bank leadership's responsibility typically comes from neglect and failing to create effective structures, systems, internal controls, structures that create poor incentives, or failing to create structures that effectively detect and promptly respond to operational risks. So there's a mismatch that also obstructs effective sanctions and effective mechanisms for holding senior management accountable. And both of these design problems make it so that it's much harder for regulators to pursue enforcement actions and hold senior leadership accountable versus, again, rank and file employees.
So here's a key point that you bring up, which is rewarding so-called bad actors, poor management. Did that happen with Silicon Valley Bank or with JP Morgan coming to the rescue of First Republic?
In terms of rewarding, well, what we know publicly is that it has been that the executives at Silicon Valley Bank, the executives at Signature Bank, certainly received compensation and paid out compensation to themselves in advance of their failures. Now, it's not clear whether that is pursuant to, for example, a insider trading plan or other forms of other mechanisms, but that is troubling. And so in some ways, we're seeing that executives are at least not being held accountable for the conduct that led to these bank failures.
So bottom line, where are the enforcement holes? What needs to be fixed or changed?
As I mentioned, I think prohibition from the industry is an important tool in regulators' arsenal. It comes on top of their ability to impose civil money penalties, so fines, and their ability to issue orders that restrain certain identifiable activities. It is a mechanism that targets incentives at the individual level, much like how private shareholders are able to hold executives accountable by electing them, and by the boards of directors accountable by electing them and by terminating them from the corporation. So it's an incentive that operates on an individual level, and we need to strengthen it. We need to strengthen it by lowering the culpability requirement to something that makes sense for senior leadership and the way that they operate within a bank. So instead of willful, perhaps reckless mismanagement or even negligent management should suffice. And second, we ought to identify mismanagement and oversight failure as a distinct basis for removal and prohibition from the banking industry. This resolves the problem that I mentioned earlier, that the focus of the statute is on who committed the wrongful, discrete activities, but not for a responsibility for who set up the structures and the incentives that led to those activities.
Final question for you. And again, thank you, Dr. Lin, for being with us. Signature Valley Bank, Silicon Valley Bank, and First Republic, any common denominator in these three banks?
So based on the reports that were released by the Federal Reserve and the FDIC last week, one concern that both have raised is that the two banks, the management at the two banks, chose to pursue short-term unrestrained growth without adequately controlling for critical balance sheet risks. So the company grew so fast, and the executives were incentivized by their pay structure to focus on the growth without paying attention to the safety and soundness issues that they were creating. And that's something that I hope additional reforms and attention will be paid to.
Professor Lin from the University of Richmond, thank you very much for being with us. I encourage our viewers to check out your testimony yesterday before that Senate committee. Thank you very much.
Thank you so much for having me.
And to our two former members of Congress, let me begin with former Congressman John Delaney. Very simple question. Why is this happening right now?
Well, in some ways, it's another second or third order consequence of COVID, in my opinion. What happened during COVID is we deployed extraordinary fiscal and monetary stimulus into the economy. And what that meant was we kept rates at historic low levels, and we injected a huge amount of money. In other words, the money supply in this country went up dramatically during COVID. A disproportionate amount of that money went into the banking system, and bank deposits grew. Silicon Valley Bank, in some ways, is the simplest way to think about this, because Silicon Valley Bank went into COVID as a $50 billion in asset institution. It left COVID as a $200 billion in asset institution. To the professor's point, that was dramatic growth. What was interesting is most of that growth was simply in cash. They actually didn't make a lot more loans. Their loan book certainly grew, but what really grew was the deposits in the bank. And again, that kind of makes sense, because what happened during COVID is there was this sense that the world was changing. Everyone was going to work remotely. We're going to change the way we live and interact with each other. All these technology companies would enable it. There was a huge bubble in technology investing in stocks, and a disproportionate amount of that capital flooded into Silicon Valley and flooded into Silicon Valley Bank, the bank for Silicon Valley. What Silicon Valley Bank did, which was really dumb, is they took that cash and invested it in government securities. To some extent, what's amazing about Silicon Valley Bank, they actually blew up a bank with government securities. If we would have asked ourselves 5 or 10 years ago to try to figure out how to blow up a bank with government securities, that would be pretty hard to do. You know, banks normally blow up because of credit risk, meaning they make a bunch of bad loans. That's not what's happening here. I mean, people are worried about that, about commercial real estate down the road. But actually, the professor was right. They did engage in kind of massive growth, but they actually didn't really grow the kind of stuff that's normally risky in banks. They actually just grew their cash, and they took that cash and they made a really bad decision. I don't think it was willful misconduct. It was just like basic bad judgment. They took all that cash and invested it in long-term government securities at historic low rates. And because they received so much cash, most of it became uninsured, right? Only 5% of their deposits was insured. So they had a huge amount of kind of lazy money sloshing around in their bank, uninsured, that they invested in government securities at incredibly low rates. And then what happened? Rates went up faster than they ever have, actually. This rate of increase of interest rates is the fastest ever on record in terms of the percentage of increase. which obviously made them insolvent because all those safe government securities they thought they were buying, they went way underwater. And people figured out the bank was insolvent. And they realized a lot of their money wasn't insured, and they just pulled it out. It was an old-fashioned run on the bank. It's kind of similar to First Republic. I mean, slightly different story. They didn't invest as much in government securities, but they did a lot of that. But they invested in very low rate, very safe. They're not going to lose any money on these loans, but very low rate mortgages. Again, when rates went up, those mortgages became less, went down in value dramatically. Most of the money in First Republic was uninsured as well. When people realized they had a solvency question, they pulled their money out. So this is really a crisis of the uninsured deposit, meaning what's happened to the banking system over the last several years is a very large percentage of deposits became uninsured. You know, if you read about the banking system way back, there was always runs on the bank. And the way banks used to deal with that 100 years ago is they would actually bring gold into the bank. They'd pile it up behind the teller, and people would see that the bank had money, so they'd stop taking their money out. Because we couldn't do that anymore, we came up with FDIC insurance. That was effectively the gold. Your money is guaranteed in the bank. But what's kind of happened over the last couple of decades, people became lazy and they allowed large amounts of their money to be uninsured in banks. And people are waking up today and say, wow, I really want my money in either treasury bills because they pay well, or in money market funds because they pay well, or I want it insured. I don't want to keep it uninsured in banks. And that is destabilizing the system right before our eyes.
And Congressman Delaney, I'm reminded from that scene, It's a Wonderful Life, when you say a run on the bank, and I think we can all relate to exactly what's been happening with these banks. From a Republican perspective, Congressman Hultgren, thank you very much for being with us. As you hear what Congressman Delaney has said, he's put a lot on the table. React to that, and my question to you specifically, is there more to come? Should investors, should depositors be worried about banks moving forward?
Steve, thanks. So good to be with you. And I do want to just give a great greeting to my good friend, John Delaney. I miss him. We work together very closely in the Financial Services Committee. And so appreciate him so much. And honestly, agree. I thought he laid it out so well of what this happened. What I would add to it, and really what makes it different from It's a Wonderful Life, is Mr. Potter didn't have a Twitter account. And he also wasn't able to move money on a Sunday. And that's different right now. You know, it's wonderful, all the new technology that we have, the opportunities that we have through social media, through communication to be able to get information out quickly. The problem is there's not a very good check on the quality of that information. And the other thing that I love is the ease of banking, where it's very rare that I have to go into the lobby of my bank any longer. My parents are late 80s. They do all of their banking on their phone. That's a big deal. I think that's another thing out of COVID that accelerated this use of technology to be able to bank, to be able to move money quickly. Again, a wonderful tool, but dangerous when bad information gets out or people get scared. I think a lot of what happened was fear-based and driven. Absolutely mistakes that were made. We're going to find out more as we dig into some of the management, some of the questions, even some of the regulation of why was this allowed to happen in the way that did. You know, I feel pretty confident as I look at, very confident when I look at Illinois banks and pretty confident when I look at banks across the country that even today, even this morning, there's additional stability that we're seeing in banking. We're seeing some maybe banks that were a little bit more challenged in certain spots, some other California banks, some other things that today they look much better. There's a rise in confidence in investors in those banks, in the markets, but also most importantly in their customers. I work at the Illinois Bankers Association. We represent about 270 different banks, literally from the smallest bank in Illinois to the largest bank in Illinois. And I am so confident that they are doing the right things. They're doing really well. And I think by and large, the health of the banking system is very, very good. Can we be better? Always. You know, every industry always ought to be looking at how it can be better. As I've served in this role in the last 3 years, and then coming off service with Congressman Delaney, I've become more aware, I think, in the last few years, just of how much regulation banks are under. I don't know if there's any other industry, it would be very few other industries that are regulated to the level that banking is. That's a good thing. We want that. We want that consumer confidence. But we also have to make sure when those regulations are in place that they are being used, that regulators are actually using what's there. And so that's messages that I'm sending to former colleagues who are continuing to serve in financial services is absolutely, let's learn from this. Let's be aware of what else is out there. If there is activity, if there's new legislation, let's make sure it's targeted to truly address problems. Again, John and I know too often that I've seen on my side and his side as well, that there's people who look for an opportunity at a crisis to kind of push agendas. That this is not the time for that. This is the time, again, to make sure that have good, solid legislation that allow regulators to do what they need to do. As the professor brought up, if there's things that aren't quite there yet, let's look at it. I do believe that if there's any type of wrongful activity, criminal activity, absolutely, these executives, whoever they are, whatever industry they're in, ought to pay the price for that. They ought to be held accountable. But I don't want people to be using crises to be pushing other agenda items that really don't fit, that don't make sense. So sorry, long answer. I feel good. I feel like we've kind of turned the corner, but we have to stay vigilant. We have to stay aware. And my hope is, again, that this will be a thoughtful process by the regulators and by members of Congress, by the administration, to really look and see what was unique in these areas. And I think there were very unique things. We don't have any banks in Illinois that are anywhere close to SVB or First Republic of what they did, or even Signature Bank. Very different situations. So we have to make sure we don't fall into this idea of one size fits all regulation. Banks are unique. There's different sizes, and this is a wonderful thing. Again, I've come to love more than ever that I think we still have a banking system that's the envy of the world, that we've got literally small community banks that give back so much to their communities, all the way up mid-sized regional banks to very large banks. And it gives great options to families, to small businesses, to consumers, to farmers. And we need to protect that. Good policy in banking doesn't happen by accident.
And yet, Congressman Delaney, as you well know, on a new survey out just this morning, Axios, well over half of Americans surveyed, the customers at these banks are losing confidence in the banks. And confidence is a big part of how our economy runs, how the banking industry runs. All of this, as you indicated earlier, coming at a time when interest rates are increasing. So I wonder if you can address that point.
Sure, I'm happy to. And I agree with everything my good friend Randy just said, and I share the sentiments. It's great to be with you here today. Yeah, I mean, they are losing confidence. I mean, it's unfortunate because, again, I agree with Randy. I think the banking system is fundamentally very sound, certainly much more sound than it was during the financial crisis. Capital levels are higher, banks are better run. Silicon Valley Bank and First Republic were very unique institutions. There's really nothing quite like them in the banking system. And I do think they're outliers. I do think there's a misconception, not to blame the media. It's always kind of easy to blame the media for things, but there are some stories being put forth that are clearly not rooted in the facts. I mean, one of the institutions, Western Alliance, which is a large regional bank that's been under some scrutiny, by most objective measures, it's a completely solvent institution. Again, I'm not an expert on the institution, so don't take my word for that, of course, but that's what most people believe. Yet there were stories yesterday that they're desperately pursuing a strategic merger, and they came right out and said, nothing could be further from the truth. It's absolutely false. Now, they say these things and they're publicly traded, so they understand the implications of a misrepresentation. So assuming what they're saying is true, which it must be, because they're big, they're public, they have good lawyers, they wouldn't say they're not pursuing a strategic acquisition if they in fact were, but there are all these stories about it. And it really does feel like there is a bit of a market manipulators in the media are definitely enjoying trying to take down banks here, it feels to me like, and it's undermining confidence in the system. And it's unfortunate because again, you said it, Steve, it's a confidence game. Banking is fundamentally a confidence game. Some very significant mistakes were made by two very unique and large institutions. Bad judgment. It actually wasn't self-dealing. It wasn't the kind of stuff that happened in the banking crisis in the 80s and 90s where like CEOs were lending to properties that they owned but didn't disclose. You know, you had all that stuff going. It was none of that. This is just people making really basic, dumb interest rate management mistakes, which is saying interest rates are going to stay low forever. And I'm going to make that bet in a bank, which you're not supposed to do. You're not supposed to make interest rate bets in a bank. You're supposed to try to get banks as interest rate neutral as possible. So I do think that this confidence question is the most serious question. I think the regulators need to be speaking out about this more. I think the regulators need to make it clear that stock prices are not relevant to how they think about institutions. They regulate these institutions. These institutions file documentation, call reports regularly with the regulators. They're on top of them. And if they feel they're solvent, which they must if they're still operating, if the stock goes down, like, okay, stocks go down, stock goes up. That is actually not a barometer as to the health of a bank at that moment in time. And I think the regulators need to make that message clear. And they also need to make it clear that the institutions they view as solvent, they will ensure they have all the liquidity they need to operate their business, so that they will backstop liquidity runs on solvent institutions. They've done that, but I think they need to make that point more clear.
You are both really showing your expertise in your current role, but I want to ask you about your former role, both members of House Financial Services. And we know later this month that the CEOs and executives from Signature and Silicon Valley Bank testifying before congressional committees. So based on what we're talking about today, Congressman Hultgren, what questions would you pose to those executives? What more do you want to know that you don't know right now?
Well, I think it is drilling in, like John said, some of the decisions that they made. Why did they make them? Why did they? It appears, especially Silicon Valley, but maybe some others too, that didn't have proper risk management, people in place with expertise to be able to make sure that they weren't, that they were looking at all eventualities, that nothing was off the table. So it is finding the specifics. Also, asking questions of what happened with regulators. Did they do what they were supposed to do? Did they use all the tools that they had to be able to check on these institutions? Or did some things get missed? Were they focusing on certain parts of regulation while not focusing or addressing other parts of it? It's really important that all of those tools are used, again, to make sure that our banking system remains incredibly safe, sound, and there is confidence by customers, by communities. So my hope is, again, finding out specifics that happened here. And I think that is going to be the biggest story out of this. Was there were some unique mistakes made in some very unique institutions that others ought to learn from. And I can assure you, Steve and John too, I know John at his bank do this all the time, but my bankers in Illinois are looking and confirming, are we who we thought we were? Do we have, and it used to be that banks or business, would say, well, if this happens, then we'll do this. Reality is now bankers are having to look at maybe 6 or 8 different scenarios of, if this happens, we'll do this. If this happens, we'll do this. If this and this and this happen, we'll do this. That's challenging, but they're up for it. They're willing to do it. They've got, they're leaning into it. And I'm seeing really good things happen as I'm talking to my banks every single day, again, from smallest, medium-sized, regionals, largest. They're saying, we're doing the right things. We are not in that same place. We're nowhere near the uninsured deposits that these institutions have. And so, again, I'm really confident that Illinois banks are strong. My hope is our representatives from Illinois, from other places that serve on the Financial Services Committee can dig in, identify the specifics of what happened in these banks, mistakes that the leaders of the banks made, and were there things that any kind of failure of regulators? Let's address that as well. And if there are lessons to be learned to make banking better, safer, stronger, let's look at that. Always with the understanding that there's costs with it. There's effect. Every new regulation that comes in takes time, takes effort. It's important, and our banks want to comply with that. But the reality is, again, I know John sees this all the time, that you have to move people who could be out serving the community, serving customers, into focusing on compliance. Again, very important. They will do it, but there's a cost to it. Ultimately, a cost to customers of that personal relationship, that help that they can get from a banker that can walk alongside as they're pursuing a piece of their dream that they want to achieve. So I hope those questions are asked. I hope there's this clear identification of what was specific in these situations. Let's not legislate to specific institutions or specific mistakes in institutions. Let's make sure if there is legislation or new regulation, it is for the betterment of the industry with an understanding of what eventual costs might be a part of that.
So John Delaney, let me pick up on that point, because
Sure.
why and where did the regulators fail?
Well, I just think that, let me just take one step back and I'll answer that question. What happened with Silicon Valley Bank and First Republic really has changed the way everyone thinks about banking. And we talk about management failures, regulatory failures, but the thing you have to remember, Steve, and I know Randy, I think Randy would agree with me, if you were to turn the clock back a year and you would have surveyed experts on banks, investors, analysts, management teams, even regulators, and had them make a list of the 20 most admired banks in the United States, I assure you Silicon Valley Bank and First Republic would have been on those lists. These were institutions that were given premium valuations. In other words, they're public companies, their valuations was the highest of any banks in the country. They were admired for their unique business model. They had an attribute associated with them that was admired by the market and by regulators. What that attribute was, is they had a lot of low-cost deposits in their banks. First Republic's cost of funds, cost of their deposits last year was lower than JP Morgan's, to put it into perspective. And what these banks basically did is they engaged in activities, a business model that in some level was uneconomic. What Silicon Valley Bank did was provide exceptional service to venture community. Wonderful professionals, respond to every need you had, help them get accountants and lawyers. They were really a service provider to that community. In exchange for that, they got lots of cheap deposits. First Republic largely serviced high net worth individuals. They provided them mortgages and customer services at very low rates and exceptional service. The customers loved that bank. In exchange for that, they got all these low-cost deposits. That was actually viewed as an enviable business model. Today, what's happening is people are saying, well, if you have excess deposits above insurance, that's a risk. And in many ways, Silicon Valley Bank and First Republic, that was their business model. And if you're paying super low rates, like that doesn't make any sense. Like from a consumer compliance, why should someone be getting paid 100 basis points on their deposits when they could buy treasury bills for 4.5? Right, so all of this is changing. The banking business, I think, is going to go back to basics, which it should. Old-fashioned lending, paying people a fair amount on their deposits, making good loans, doing compliance well. And not running kind of overly complicated business models to get super cheap deposits, which, by the way, were admired by everyone, including the regulators. So we can point a lot of fingers, but we have to realize everyone looked at this wrong. Right.
I keep going back to that scene from It's a Wonderful Life, going back to the basics, because I think that's something that we can relate to.
This crisis is going to change how people think about things. So clearly, what did everyone do wrong? They underestimated the interest rate risk that these banks were building up. And they didn't think about how that correlated to runs on the deposits because they had high uninsured deposits. So they didn't look at the ratio of uninsured deposits and the amount of interest rate risk they were assuming. And they didn't draw the linkage that should the interest rate risk materialize and the bank lose money, a lot of the deposits would live. Everyone missed that. The management teams, the regulators, everyone missed that.
Which brings us back to the FDIC, Congressman Hultgren, because there are some proposed reforms, which I'm sure you're familiar with. What does the FDIC need to do differently? What specifically should it change, if anything?
Well, I think, again, that discussion is an important one to have. And we've seen from Chairman Grunberg, the report that just came out this week, and laying out some frameworks of different directions, boiling it down way too simply. We could either do nothing, we could insure all deposits, which I don't think is going to get a lot of support out there, or we can do, targeted support, kind of this business focus. I think, again, it's going to be an important discussion to have. I don't know exactly what FDIC ought to do. My banks, we talk to them literally every single day. They're not in unanimous voice of what is the right step of going. Reality is FDIC insurance works. It's worked for 90 years. Insured deposits, there's never been a loss to a customer of FDIC insured deposits. It works. And even this system, the problems that we've seen through these banks, the system works. It wasn't a cost to taxpayers. It wasn't anything else. It was handled in an appropriate way, in a transparent way. We saw even with First Republic, the bidding process and things like that with JP Morgan Chase ultimately being the one to step in there. But the process has worked when there is a problem, when there is a challenge, and I hope they recognize that. So again, as the FDIC looks at this along with elected officials, with legislators, my request is make sure you have bankers at the table because they really want this industry to work. They love it. They're committed to it. They don't just love it because it's been a good career for them. They love it because it's fulfilling. It's helping people who want help. My own personal story, grew up in a family funeral home. We never would have had that opportunity, but for a community banker that gave my mom and dad a chance to be able to buy it when I was a kid. Changed my life. I would never have served in Congress, would never be doing what I'm doing now, but for that community banker. This idea of making dreams come true is real. You talk about it, George Bailey, of the fulfillment of it. There's still, obviously that's glamorized, it's Hollywood and things, but there is some real positive impact that someone who works in a bank can have, helping people maneuver and pursue their dreams and ultimately give back to their community. So my hope is, again, that the FDIC is looking at what got missed. Were there things, tools that regulators had that could have been used more? And then ultimately, who pays the price? If we were to increase that level, that $250,000 level, how is that distributed? I think it is really important. I've heard this from different members of the committee still, that we want accountability for banks to make good decisions on investments. As John mentioned, I couldn't agree with him more, that there were some big mistakes that certainly these banks made, but also the regulators made by missing some inappropriate investments that were made, not looking at the potential of rapid increase of interest rates. So, as we look at this, who's going to pay the price if there is increased insurance? And one of the things I would just say, common sense, but maybe it's a good thing to remind people that if you've got any questions about your bank, your banker, give them a call. Don't believe necessarily what you see on media or social media or whatever. Talk to them. It's one of the beautiful things, again, that I love about banking is it's still relationship driven. There's still a relationship there. Ask questions. Our banks have really been grateful for the opportunity over the last couple of weeks to be able to explain the difference, why they are so vastly different than these banks. And it's instilled confidence over and over and over again. I've heard of customers coming back and saying, okay, I'm keeping my money here. I believe in you. We're going to stick together and impact our community for good. Love that. So big decision, I think, is this the right level, the $250,000 level? Do we need something else for specialized loans? I'd love to hear what John's thoughts are on this. I haven't been able to get a one clear vision of we got to do this, but from my bankers, they have different ideas. But one thing I do hear that they all agree on is it works. FDIC insurance, the $250,000 has never failed. It's always been there for customers, and that's a really important thing.
And John Delaney is a board member here at the Bipartisan Policy Center, full well, and we so appreciate your expertise, by the way. And I think our viewers today can sense the depth of knowledge you have. But you can follow up on what Congressman Hultgren said. I do want you to explain very simply, when people say taxpayers are on the hook with the FDIC, that's not necessarily the case. So in responding to the congressman, if you could educate the audience on how the insurance plan program works.
Sure. So the way the insurance program works is banks pay a fee for deposit insurance, and there's a complicated way their fees are determined. It's not relevant, but banks pay fees, different banks pay different fees. That goes into a big pot. Going into this little crisis that we're in now, that pot was about $130 billion or something like that. And if there's failures like there have been, and there's losses to the FDIC for backstopping these deposits, they take the money out of that fund. They have a backstop line of credit from the Treasury, right? To the extent they deplete all that right now, say 128, they can borrow another 100 billion from the Treasury. but it never actually does affect the taxpayer because they replenish that fund by raising fees on the banks. So it's effectively a bank self-insurance program that the government has authorized the creation of, and it's fully funded by the banks. It's also why, putting aside whatever the level of the insurance is, which I think it should go up, they are never going to let anyone lose money on a deposit, in my opinion, even if it's not insured. And the reason for that is it would cause a lack of confidence in the whole system. And why would they do that when in fact they're not even paying for it? The banks are paying for it. So if you just think about alignment of interest, the FDIC, and they can't say this publicly, but I'm just saying what I believe to be true, they will never let anyone lose money on a deposit in the bank, even if it's uninsured, because that would put into question the whole system. And that would really affect the country because banks are really important in this country. Banks link savers with borrowers. They allow people to put their money in the bank and sleep well at night, and they allow businesses to get loans, create jobs, and build our economy. It has been a singular success. If we didn't have the US banking system, there's no question the US economy would not be as big as it is now, and we would not be as prosperous. So the regulators understand this, and they understand confidence is important, and so they're not going to let anyone lose money. And in fact, it's not even the government or taxpayers' money that they're spending when they don't let anyone lose money. They're spending future assessments on banks. They're spending their money. So if you have that perspective, which I do, I obviously think you should increase the insurance because it's all kind of a fiction anyhow. And you might as well organize it in a way where people feel better about it and maybe get greater fees. You know, banks don't love paying fees, but the bigger the FDIC insurance fund is, the better everyone feels about it. And it's clearly time to do that, particularly for business transactional accounts. You know, if you're just saving money, you should maybe be a little more mindful because you're not transacting with your money and make sure you spread it around and not have too much in any one bank. But if you're running a business and you've got payroll and all these needs and you're collecting money and paying out, it's very hard for you to say, oh, I can't keep more than $250,000 in that account on any given day, right? That becomes a cumbersome thing. So we should definitely increase it for business transactional accounts, and I would probably increase it generally. But I think the key message, at least from my perspective, no one's ever going to lose money with a deposit in a bank. And the other thing is we have to remember how important the banking system is. We can beat up banks all day long and all this kind of stuff, and the banking system can shrink and shrink and shrink. All that credit will be provided by lenders that aren't regulated and don't operate to the standards that banks do.
So just to be clear, because we had a question from one of our viewers that you would do for both business transactional accounts and large individual accounts. Is that correct?
Yeah, I mean, I might do them differently. I would probably increase the, I would increase both of them. I'd probably increase the business transactional account more because that's a harder one for people to manage their balances because they it goes up and down every day. I mean, the Bipartisan Policy Center, even think about it. You get donations, you have this and that, and you pay payroll and you do these events. Every day your balances move around. It's hard to like manage that to a number every day that you don't want to have in the bank.
Let me follow up on two final points, and Congressman Delaney, I'll stay with you because you're very much involved in a green initiative and sustainability when it comes to banks. It might be worthwhile to just spend a half a minute or so to educate our listeners and viewers on that effort.
Right. So Forbright is a bank that has sustainability and decarbonization as its mission. And we're not judgmental about it. We just think the world needs a bank to help finance this transition. And we think that's also good business. And you can run, 95% of our deposits are insured, and we have no securities in our liquidity portfolio. So you can do this and also run a sound bank. And again, it comes back to my point that banks are really important. They connect savers to borrowers. And in doing that, they shape the economy. And I think banks need to play a role in driving sustainability, in a balanced way, in a non-judgmental way. But I think banks can play a huge role in helping to finance a cleaner, greener, lower carbon, more sustainable and equitable future. And that's what we're trying to do at Forbright.
Final question for both of you, because we have a number of reporters also viewing this webinar today. And again, thank you for your time. Next Tuesday, there will be a meeting at the White House with the four principals from Congress, the congressional leaders, and the president. The Treasury Department says June 1st is the X date when it comes to the debt limit. So with regard specifically to everything that we have been talking about today with the economy and the banking industry and concerns over the debt limit and what Congress can and needs to do, Congressman Hultgren, give us a sense of what you can expect, what you think we can expect over the next month or so.
Well, again, I hope we can have working together. I hope with White House working with leaders in Congress and House and Senate all engaged in this, that we can just get this done. There's enough unsettled things out there right now that we need to make sure that we pay our bills. But, you know, I think we also have to be thinking about debt and spending. So this is an important discussion to have. But again, for economies, for banks, for business, for families, my hope is that they get this figured out, that they come together. And as Bipartisan Policy Center is all about is, you know what, there's a lot of things that we agree on that are good for our nation, for our world, for economy, for families. Let's get those things done. And so my hope is that we just get this done. Don't flirt with it. Let's figure it out. Let's don't leave town until it gets done. So that's my hope that happens. We'll see. Unfortunately, it's a very politically charged time. It seems like it always is. We never get out of those, but it seems like they're getting more so than when John and I had the privilege of serving. It even feels like it's more intense and more visceral. But my hope is, again, that calmer heads prevail, both sides come together and say, how can we find common ground here to be able to move things forward, ultimately to build confidence in our economy. And again, I just want to reinforce people ought to have confidence in banking. It's wonderful. Couldn't agree more with my good friend John Delaney that banking is amazing. We've got a wonderful system. People ought to feel confident. And if they've got questions, again, don't believe a tweet. Call your banker, talk to them, find out specifics.
And John Delaney will give you the final word, especially with regard to this looming debt limit issue.
So we've got a really good thing going in this country, and we shouldn't screw it up. So I agree with Randy, which is we need to just deal with this. Look, at my perspective on this is as follows, which is we should raise the debt. I would get rid of the debt limit. It doesn't accomplish anything. You know, we have been fiscally irresponsible, and certainly the debt limit hasn't helped us become more fiscally responsible, right? So it's kind of a stupid thing, in my opinion. I'm in favor of a clean increase of the debt limit because it's, you hear how I think about it. So of course we should just raise it. Having said that, I do think the fiscal trajectory of this country is getting very concerning. When I was in Congress with my good friend Randy, in the Financial Services Committee, the chair used to put the debt clock up on the screen. Remember that, Randy?
Absolutely, I do.
And the number was very large, certainly in absolute dollars. But I would say to my colleagues who were very concerned about it, I would say, listen, but we're running 70% of GDP. That's a manageable number if you think about historical averages, et cetera. I would answer that question differently now. I would say now we're above 100% of GDP, which is really the only time we ever did that was when we were saving the world during World War II. And by the way, back then we borrowed all the money from ourselves, which is very different. Your debt doesn't almost matter if you borrow it from yourself, right? Because it's effectively just internal accounting between the citizens and the government. But when you start borrowing from other people, as we do, increasingly it becomes troubling. And with the interest rate projections that they are, the deficits will be very large. And this number is really, at this point, becoming, in my judgment, approaching unmanageable. And we have to enter an era of no more tax cuts and certainly no more unpaid for spending increases. And we really have to restore discipline. So I'm certainly sympathetic with that argument. I just think we should just raise the debt ceiling because that's actually has nothing to do with fixing those problems.
John Delaney, Democrat from Maryland, Randy Hultgren, Republican from Illinois. Thank you for explaining and educating to our BPC viewers and listeners on this rather complex issue and a very timely issue. Let me turn back to my colleague, Michelle Nellenbach, and thank you both again for joining us.
Thank you, Steve. Good moderation.
Yeah, thank you so much.
Well, thank you to all of our speakers for today. That was a really incredibly informative discussion. I hope those listening learned something today. I certainly did. And I would encourage you to just keep an eye out on BPC's website and social media as we continue to dive into these issues. Thank you again for joining us today, and have a lovely weekend.